Unfortunately for us, it is an election year, which means between now and November, we are going to hear a whole lot of stuff about what helps to grow the economy and tax cuts and top-down economics. But does it actually work? And what is top-down economics? And are there points in history that we can look to tell us the truth? Let's go ahead and break it down. The term top-down economics, or really trickle-down economics, started in the 1930s, 1932 to be specific, with a man named Will Rogers, who was from the state of Oklahoma. So there you go for your trivia. But it really became more popular in the United States in the 1980s with President Ronald Reagan. We were going through a recession, and the thought was if we cut taxes for very wealthy people and these major corporations, they would take that money and invest it more in the economy. They would hire more people, buy more stuff, and that is what's going to stimulate us and get us out of any recession that we run into. Here's the thing, it actually worked. It actually worked in the 1980s, and we did get out of the recession. Now here's the thing. That wasn't the only thing that occurred during that time. And speaking of tax cuts, let me give you a little bit of perspective. The top tax rate in the 1980s was 70%, and that was cut all the way down to 28%. For federal corporate taxes, it was 46%, and that was cut down to 40%. Now, before you freak out, if you made $100,000, they were not taking $70,000 from you, okay? That is not how tax rates work in the United States. We call it a progressive tax system. It is a stepped up basis. So if you make above a certain amount, just that amount above it is going to be taxed at 70% in that case. So for example, let's say that the threshold for 70% is $100,000, right? So that means you would have to make $101,000, and that $1 above that rate is going to get taxed at 70%, not the entire amount. Okay, so I have an entire video breaking that stuff down, but 70% to 28%, they cut it majorly, right? Not sure if that's a word, but they made a significant cut. We did get out of the recession. But what else happened during that time? Government spending increased by 2.5% each year during his administration. So what initially occurred is you brought down the government's budget and increased spending. Now, most of that spending was made on defense contractors, companies like Lockheed Martin and Boeing and others, and that is something that can help those stock prices, that can help us investors, so on and so forth. But government spending is something that has shown to help the economy. We saw it in 2008. We saw it recently with COVID, where they pushed out that stimulus and they pushed out a whole bunch of these programs where people were taking that money and spending it, and we got out of the recession. In fact, in 2020, due to the COVID Relief Acts, that was the fastest recession we've ever gotten into and out of, partially due to government spending. So was it really the tax cuts, or was it the government spending? It's really kind of up in the air. But one thing we should also note is that the U.S. debt also tripled during that time to $2.85 trillion. So tax cuts have a direct impact on what happens to the debt. So if the 1980s wasn't a great, clean experiment, well, let's go to 2001 and 2003, where President Bush cut taxes twice. And we were running into a rough patch during that time for a lot of the reasons I'm sure you already know, with 9/11, the tech bust, so on and so forth. Well, they cut taxes twice. We did get out of those recessions, hooray, up until 2007, 2008, we ran back right into one, but we got out of those recessions, which was a good thing. But again, what else happened during that time? What was a major event that occurred? The Fed cut interest rates from 6% down to 1%. And most people, just as we've seen again, we see that when you start to cut interest rates, people start to do what? They buy and they borrow more. And that buying and borrowing helps to stimulate the economy. Remember, 2/3 of our entire economy, I was going to say 66%, 67%, it is still 2/3, but 2/3 of our entire economy is built on consumer spending. People like me and you spending. And when we start to see interest rates come down, we go buy stuff. We go buy houses. You're going to see why I did that for a second. But we go buy houses. Businesses loan out money. Businesses take money and grow, right? And invest in other products and services. Take Amazon, which was coming of age right around this time. They borrowed tons and tons of money. They were extremely unprofitable, during that time, and became the company they are today, in part due to that cheap money. Now, the reason why I, kind of winked and nodded there is because those interest rates were really cheap, and people borrowed and probably shouldn't have in that case. That is the thing with you know, that's the thing that got into the Great Recession due to how mortgage prices exploded and interest rates changed from the early 2000s to 2006, 7, 2008. I'm not going to get too deep into that. I think we've already done a breakdown on the 2008 recession, but basically we had ARMs, adjustable rate mortgages. So when you got the mortgage when it was at 1% and it explodes and now it's 5 in 2007, stuff gets real rough real quick. Okay, so that interest rate, you could argue that the interest rates did help us get out of the recession and also put us into another recession, but I could also argue the banks should have been creating those types of products. Conversation for another day. But again, 2003, 2001, yes, we cut taxes, but the interest rate also changed. And we've seen the impact of interest rates over the last 2 years or so. So maybe that wasn't as clean. So is there a case where all they did is just cut taxes, just do the trickle down, and did it work? The answer is yes, there is a case. And ladies and gentlemen, let me turn your attention to the state of Kansas, where in 2012 to 2017, the state of Kansas reduced income taxes for individuals by 1/3. By 1/3, which sounds great to my pockets, but they also reduced business income taxes to $0, which means if you had a small business, if you put your stuff together, you would have a $0 income tax in the state of Kansas. Did the state of Kansas see a growth in their population, or really in their, because we don't really care about the population per se, but did they see a growth in their economy? No, they also did not grow faster than what they did before the tax cuts. And then we started to see the state take on a whole lot of debt and actually get in the red, where they had to repeal their own tax cuts in 2017. It hurt the economy so much in the state of Kansas that people started to see essential services and things get cut. Because remember, again, when you cut taxes, you cut the government's own revenue and income. So you're cutting your own revenue and income, but your expenses are staying the same, or in the 1980s grows. That is how you get a major state deficit in the state of Kansas, or a national debt and deficit, which is what we are dealing with today. So based on history, the answer is no. Trickle down economics does not work. Cutting taxes to grow the economy does not work. It sounds great on paper, but look at it like this. You're watching this channel, right? Okay, especially if you watch at this point, you are deep into this, right? So here's the thing. You are here because you like investing and saving and all that stuff. So if you get a raise or somebody cuts your taxes, you are going to do what? You're going to invest and save. You're not going to go out and frivolously spend on stuff, on goods and services. Now, you may spend some of that money, but the majority of it is going to go towards the stock market. It's going to go to your savings account, which is not necessarily the thing that is going to go and help the economy grow. So no, it's not something that really works when you cut from the top of business income, major corporations, all that type of stuff, and hope that it trickles down. It's just not a theory that history has shown has worked. Which leaves us with the big question is, well, what does work? What is the thing that does help to spur the economy, to kick things into gear and provide prosperity for everybody? Well, number one, if I had that exact answer, maybe I would be running for office, or maybe I would have sold that to, I don't know, some contractor or whatever. But history has shown us that it is government spending. Now, depending on what they spend money on, but government spending is something that has helped. Think of the Great Depression and the New Deal. That was a huge amount of government spending that helped to get us out of the Great Depression. We also saw a little bit of that in 2007, 2008. And then I know you saw it with all the COVID bills and stimulus checks and all that stuff that helped to get us out of that recession too. So that seems to be the biggest and best way to get out of a recession and to help grow the economy. Now, you can't do it forever. You can't just, be throwing out money and printing money for forever and ever, which would be great, but that's not the best thing possible. We have seen how that has hurt us when it comes to inflation. So there is a limit and a balance to what you have to do with adjusting interest rates, government spending, stimulus checks, and things of that nature, which makes the job of an economist or the job of the Fed extremely difficult, or even the job of passing and getting your degree in economics very difficult as well. So it is something that you do have to balance. But what are the other things that you should know about the economy, especially going into this year, and other investments that might be a place that you want to at least raise an eyebrow at? If you want to know about those topics and about what you should be investing in right now, you want to check out these videos right here.